A nation in peril. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major government is on the brink of its most severe crisis since the financial collapse. And you're not going to believe who it is, what they're doing, and why they're putting the entire global economy at risk. Plus, China's house of cards is about to come tumbling down. And if you're wondering what we're doing at this gas station today, well, it has everything to do with expectations. Now let's head over to the Wall Street Journal, where we picked today's story up with the headline: the RBA revises up near-term inflation forecast, warns that inflation is more persistent. And this is the issue now that we're facing, is that central bankers keep moving the goalpost around, and now they're concerned about expectations. And so what this means is that consumers around the world are starting to believe that inflation is going to rise. Now, from a central banker's perspective, what this means is they're going to go out and spend money today and drive prices up even higher. Of course, we're making the case the real issue is demand is coming crashing down, and the consumers can't afford higher prices to begin with. So anything that these central bankers think is going to drive inflation up, well, they're completely wrong. The problem is they set policy about this. Overall, the RBA expects inflation will be at the top of its 2 to 3% target band by the end of 2025. But its outlook now assumes greater risk in the near term, which, if realized, could underpin further interest rate increases. And this is the expectations now that central bankers have. They believe we're back in the 1970s. They think we're going to see a big surge in inflation here. They don't want that to happen. And so they're trying to front run it by raising rates even more, or at least putting it out there that they're going to. The problem is they have no clue what drove inflation back in the 70s, and the setup then does not exist today. The issue right now is we have declining demand, and that's something the central bankers can't see happening. Inflation in Australia has passed its peak, but is still too high and is proving more persistent than expected a few months ago. This according to the central bank there. The board's priority is to return inflation to target. Whether further tightening of monetary policy is required to ensure that inflation returns to target in a reasonable time frame will depend upon data and the evolving assessment of risk. And so what they're trying to do here is bring inflation down. They want to bring prices down. The issue they believe is that the global economy is so robust, that the labor market is really strong, and that all these expectations, again, of higher prices mean, consumers think if that TV I want to buy is going to go up in price, well, then they're going to go buy it today. The issue is they don't have the money today. They don't have access to the credit today. The real issue the central bankers can't see is it's not a matter of demand going higher. The problem is demand is going down. What they should be focused on is what can they use their policy tools to get supply up. That's the problem they're missing. They've got it backwards here, but what's going to happen, as we know, is inflation is going to come crashing down. And here we can see the consumer price indexes for the U.S. against the University of Michigan inflation expectations. That's shown in red. And what we can note is inflation expectations continue to trend lower. Now, around the world, we're seeing longer-term inflation expectations rise. But in the short term, we know that consumers are feeling tapped out. They're not getting the wage increases that they need to keep up with inflation. So as they think prices are headed higher, they're just thinking and turning around saying, you know what? I'm going to consume less because I have to assume that other things I spend money on, such as rent, food, and electricity, are going to go up in price. And that's the issue, is we're actually going to see a real decline in demand. But again, the central bankers don't get it. But now let's head over to China, where we see the house of cards on the verge of collapse. As China's support for top builder revives calls for broader state rescue, the bailouts are coming. We've said this would likely happen when they find out their banking system's on the brink of failure. As most market players are looking for Beijing to unveil further steps to reverse a long-term running slump after a pivotal week where authorities signaled their backing for China Vanke, the second largest developer by contracted sales. On Tuesday, policymakers met firms including Vanke, Longfor Group, Glendale, and Poly Developments and Holdings, according to people on the inside. And with home sales down and many developers in default, investors want to see stronger measures, including cheaper funding and local governments taking over uncompleted projects. So here we're getting calls for bailouts. And China's starting to pay attention because they're realizing that their banking system is highly correlated to their property sector. If the property sector fails, you're going to see their banking system fail. And what's going to happen is, just like a wildfire, we're going to see this thing spread through the global financial system. The problem here is we come back to the U.S. and what do we see? The small and mid-sized regional banks still insolvent. Their situation not improving. So it takes not a whole lot of push here to put the whole system over the edge, and China doesn't want to be on record as one that sends the world into the next crisis. A vote of confidence this week from officials in Vanke's hometown had fanned hopes of a broader rescue, igniting a rally in a gauge of Chinese developers before that move quickly faded, as perhaps many realized it may not happen fast enough. And during a Tuesday discussion, a regular feedback gathering, to get this, I want you to see what developers are asking for. They offered suggestions about rules that could be eased, such as limits around lending, meaning they want more money, and the pre-sale of homes before they're completed. And of course, all that means is, hey, we need you to expand how much people can borrow, and we need you to tell them they can buy properties before we're done building. Is telling you just how desperate these developers are for cash. And the whole problem here is we know the central bankers have inverted yield curves and money curves. They've constricted the creation of credit. And the longer this drags out, it's going to be a much larger crash. We're trying to kick the can down the road. The problem is the road ends with a cliff. And authorities have sought to ally the concerns, with Central Bank Governor Pan saying in an interview with a state broadcaster that the property sector risks are under control. Of course, we know that when you hear a central banker say the risks are under control, really it means they're absolutely far worse than we know, and the central bankers are just trying to put lipstick on a pig. We know that China's property sector is going down. We know the small and mid-sized regional banks here in the U.S. are going to go down at some point. We know there's other risks all around the world, and central bankers are in denial because they believe they can get inflation down to target fast enough, and then they're going to cut and believe the labor market is going to hold together. But we know the labor market won't stand a chance. And now, as I mentioned, what rot has started in China was going to spread around the world, and here we see the first signs of it in Singapore. As Singapore developer Fraser's profit slumps, get this, global downturn, there's going to be a headline we see a lot more. And one thing you're going to see a lot more is something that shouldn't be in a downturn. That's your trading account. Now, I got an email from a recent subscriber on the free trial. I put up 5 more coupon codes for CTA and Momentum Time Pro just because I got this email from this guy. He said, Steve, I'm new at trading. You offered me a free month. I jumped on it. He got in at the end of October. He says, Steve, I'm already up 14%. He says, tell your fans this stuff works. And sure enough, let's update you on our S&P 500 trade. On S&P 500, we see the SPY on November 2nd was at the max short limit. We tell our subscribers every week, these are what you want to look for. And sure enough, on November 3rd, it triggered. Now, of course, the email I got, he said he's using both reports together, just like I suggested. Momentum Timer Pros, our tactical analysis report. It looks at all those technical signals and smooths them all out for you. Meanwhile, CTA is looking at the machine positioning and what happened on November 3rd. Momentum turned positive. That's what that one signal of that buy count means. That tells us everything we need. S&P 500 put a buy it open where you see those 2 dashed lines. Many people said, are you crazy buying after 2 gap ups? And I said, look, the machine positioning, the momentum, everything says we should. And right now you'd be up 1.7% on that trade. Of course, he said he's up 14%. If you can only imagine how you could jump on these tools. Again, 5 coupon codes, links in the description below, and wait till you see what we've got coming on Sunday. All the signs point that perhaps the market's going to go a whole lot higher. But now let's talk about the third largest developer based in the city-state had earlier warned of a significant decrease in profit due to fair value losses on property in the UK, Australia, and Europe as markets slumped and interest rates rose. About 64% of the group's real estate assets are outside of Singapore. So here we're starting to see signs where the decline in property values are having issues with companies on a financial basis. We know in the US property values are falling on commercial real estate. The problem is nobody wants to show those as realized losses, but at some point the banks are going to have to face it, and we know they have no way to deal with these write-downs. So you can see what central bankers are doing here. And when you look and wait till I show you what this nation is doing, you want to talk about the wrong move at the wrong time. That's going to make the downturn even worse when you see what they're doing, and you're not going to believe who it is. But let's talk about expectations now, because we started to show out with Australian consumer expectations on inflation. Now let's move over to the US, because if consumers here are optimistic, well, we know they spend more. But if their expectations change, well, their spending goes down, and that's something going into the holiday seasons we just can't afford. As U.S. consumer long-term inflation expectations reach a 12-year high, if you don't think this is getting the attention of the Fed, well, it sure will, as consumers expect prices to climb at an annual rate of 3.2% over the next 5 to 10 years. That's not going to happen, up from a 3% a month earlier. That's according to a preliminary November reading from the University of Michigan. They see costs rising at 4.4% over the next year, suggesting that in the short term, costs are going higher compared to last month at 4.2%. Now, the issue, as we've shown, is costs are going up, but wages are going down. So the issue here is you look at it from a demand perspective. Demand has to drop because consumers are expecting prices to go higher. They're not expecting their wages to go higher. That means they're going to cut their expenses. Again, we look at central bankers. They've got it wrong. They should be focused on what can we do to get supply up. Instead, they're bringing demand down by constricting the creation of credit. And sure enough, let's take a look now at what that means. And here we can see the University of Michigan inflation expectations out in red against total compensation. This is average weekly hours multiplied by average hourly earnings of production non-supervisory employees. That's shown in blue on a year-over-year rate of change. And no surprise, as compensation goes down, what happens to inflation expectations? They go down as well, because consumers rightfully realize if they're not out spending, well, no one else is likely to spend, and that means prices indeed come down. That's what the central bankers can't understand here, is that really, while people believe prices are going higher, in reality, they're coming down because their spending is going to drop. The report showed expectations for gasoline prices over the short and long run increase to the highest this year, which is strange because it's at odds with the current trend in prices at the pump, which have steadily fallen since late September. And let's talk about why gas prices are coming down, because we know in a lot of cases rents have been going up and they're going to stabilize here at some point. We know that property insurance has been going up and that's going to stabilize at some point. We know that food prices we'll get to are coming down a bit over the next couple months, giving a little bit of relief. But the issue here is if total compensation is falling, what's your variable here? Well, it's your energy consumption. Sure, you can cut your discretionary spending, and many people will. But if they're looking to maintain some of their discretionary spending, they're going to cut back on how much they drive, how much energy they use, and that's why we're actually seeing gas prices come down. Even though expectations are they're going to rise, what we're seeing is demand go down. And sure enough, that is what matters here in terms of inflation expectations as we continue with the University of Michigan inflation expectations in red against U.S. regular all formations gas price. That's shown in dollars per gallon in blue. And sure enough, where gasoline prices go, inflation expectations follow. So even though in the longer term, U.S. consumers expect inflation to rise, in the short term, we know it's actually coming down in a big way. And we have some more evidence that proves that. And meanwhile, consumer sentiment index slid to a 6-month low of 60.4, weaker than all estimates. And while Americans were slightly more upbeat about their finances, measures of buying conditions and economic outlook deteriorated. So you think about, consumers being confident about the economy, and when they are, they spend. And so they're facing the fact that, again, total compensation is lagging inflation. That means they're not keeping up with it. And so all of a sudden, what you're seeing is expectations, their outlook are declining. The problem then gets even worse when they go to work and they're seeing, hey, there's not a lot of new orders, there's not a lot of customers coming in, and a backlog of work, well, it's going away. And everyone knows at some point that leads to layoffs, and that's where the problems really begin. The combination of expectations for persistently high prices, high borrowing costs, and labor market weakness does not bode well for the prospect of continued strength in consumer spending and economic growth. And sure enough, it does not mean good news for the economy, because when we look at consumer sentiment in blue against advanced retail sales as shown in red on a year-over-year rate of change, as sentiment falls and people's outlook declines, this is key here, their spending eventually goes down. When their spending goes down, well, that means layoffs are going up. And so we're already starting to see the initial trend of confidence fall. Of course, retail sales have been declining, even though the optimism here, we hear from policymakers saying that they believe retail sales are going to go higher. We're seeing, what did we talk about in the show the other day? We saw retailers are starting to lay off. There's a reason. Demand isn't there. The central bankers completely have all of this wrong. And nearly 1 in 5 consumers surveyed said that unemployment will cause more hardship than inflation over the coming year, because if you think about it, if you're on unemployment, your income goes down, and yes, it's going to cause a hardship because you still have all of this debt. It's at a high interest service cost, and you're going to see all these consumers that are going to hit unemployment. Their spending is going to have to massively drop. They know there's not a lot of new jobs out there, despite what the government is telling them, and yet what we're going to see is that's going to be the issue. It's not going to be inflation. It's going to be the fact they can't even get work. And yet the government's latest jobs report showed hiring was concentrated only in a few sectors, while the unemployment rate climbed to the highest level since the start of 2022 and likely to head higher, because an index of buying conditions for durable goods slumped from a month earlier by the most since November last year. A record 36% of consumers spontaneously blamed high borrowing costs, and here's a key one, or tight credit conditions for poor motor vehicle purchase conditions, simply saying, look, I can't buy a car because I can't get financed. And if you can't get financed, watch all these dealer lots get packed full of cars. Of course, we know that means they're going to be forced to lay people off. There's going to be layoffs, and they're going to be broad-based. It's all an issue. You have a debt-based economy. You need an expansion of credit. You need people to go out and be able to borrow money. We have all the indicators. They're not able to at all. And yet the share of consumers blaming similar factors for poor home and durable goods buying conditions was the highest since 1982. Of course, we know if they're not out buying, you don't need people working, and that's why every time in this cycle we see unemployment head higher. But there's some good news on the front that inflation may be coming down a little bit faster than many people think. As corn drops to trade near 3-year low on record U.S. crop. Now, this is important because food inflation has been very volatile. We've made cases why over the next several months that food prices at the grocery store are coming down. Here's more evidence as we see crop conditions improve as long as yields, and this is great for the global economy who's stuck dealing with inflation. As the most widely grown American crop is seen totaling over 15 billion bushels above estimates and surpassing 2016's previous record of just over 15 billion. Ample supplies in the top global producer means focus now shifts to upcoming crop and key producer Brazil, as well as global demand for U.S. corn. Any positive news for U.S. corn will go a long ways in supporting corn prices over the next month. And if we don't, that means corn prices are coming down. That means food prices are coming down. That means inflation is going to come down, and it's all good signs for U.S. consumers. The problem is it's too little too late. But for central bankers who think inflation's rising, well, they can't see what's going on in America's heartland. As Daly suggests, Fed may hike again if growth, inflation persists. And of course, San Francisco Fed chief is completely clueless, as we know. If inflation continues to move sideways in the labor market and GDP growth remains solid or strong, well, they're not. Well, then probably have to raise again. That's not going to happen. If those things don't happen, they come down and inflation comes and continues to come down to 2%. Well, that's a different decision. The problem is, what she doesn't understand is what if inflation starts falling markedly below 2% because the labor market goes, and that means we're now in a global recession. And I want to talk about what this major nation is doing. They're making the wrong move at the wrong time, and it's going to put the global economy at risk. You're not going to believe who it is. Let's take a look. As U.S. credit rating outlook now changed to negative by Moodys. Wait a minute, this is the U.S. making a major mistake? Absolutely. And I want you to think why, because we supply dollars to the rest of the world. And if our country slows down remarkably due to the weight of debt, well, it's a big problem, and it causes a slump to last even longer. The U.S. was threatened with a loss of its last top credit rating on Friday, as Moodys signals it was inclined to downgrade the nation because of wider budget deficits and political polarization. The rating assessor lowered the outlook to negative from stable while firming the nation's rating at AAA, the highest investment grade notch. Amid higher interest rates without measures to reduce spending or boost revenue, fiscal deficits will likely remain very large, significantly weakening debt affordability. Of course, they're suggesting the notion that interest rates go higher here. It's not really how it works at all. The problem is when governments run large fiscal deficits, they actually pull money away from the private sector, and then the private sector then finds out competing with the U.S. government for money. Somebody's got to give. It's not the government. They're going to get all of their money they need. Private sector starts to find out that they're starved for cash even more, on top of the fact that they're being starved for cash from the banking system and all of these inverted yield and money curves. The issue then becomes when we go into a downturn. And here's what I want you to be thinking. Everyone expects major bailouts and all of these money and fiscal stimulus. The problem is the government won't be in a position to do it. It's more embarrassing than meaningful, which is pretty much true. Moodys was the odd man out. It's now about psychology, embarrassing, and playing catch up to the others. As White House Press Secretary Karine Jean-Pierre said, the outlook change was a consequence of congressional Republican extremism and dysfunction. Well, it's actually caused by the fact that we borrow too much money and can't get our fiscal house in order. Deputy Secretary Wally Ademo, meanwhile, pushed back against the outlook change, saying the economy, quote, remains strong and Treasury securities of the world's preeminent safe and liquid asset. Well, the last part is true. It is a preeminent safe and liquid asset. The problem is in a downturn, when you are in a Keynesian economic system, you need to be able to borrow to pull your country out, or in this case, the global economy out of recession. With these massive fiscal deficits, we'll be in no condition. In fact, the U.S. government may face one of the worst situations, that's actually raising taxes or cutting expenses during the downturn, and that will only make the global recession even worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.